Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Chuck Fuller, portfolio manager with Nasdaq Dorsey, Wright, to discuss shifts in asset class and sector rankings and to see if we are likely to see a prolonged rally anytime soon. Chuck, it's great to see you. Welcome back to Trade Talks.
Yeah, good to see you, Jill.
It's interesting. I saw in your notes that equities are now ranking number 3 in asset class rankings because of that September-October sell-off. It's interesting. Short term, it looks as if the market's picking up some steam here. What are your indicators saying?
Yeah, exactly. So, like we said, the U.S. equities now at number 3 in our asset class rankings. Now, those are kind of longer term rankings. So, they have been, at number 1 just to start off the year, kind of fell to number 2. Now we're seeing them at number 3. So not a great sign. But like you said, these short term indicators have really gotten washed out. And this isn't the first time this year, so I'm not going to sit here and suggest that, this is the bottom. But it's probably the third time we've gotten down this low this year. And each time kind of has preceded at least a bear market rally. One of them that we typically look at is this NYSE high-low indicator. Kind of looks at the percentage of stocks hitting new 52-week highs versus new 52-week lows. It recently got down to 4%, and as low as it can go is 0%. The highest is 100, so it got really, really low. We actually saw it reverse up last night, which is kind of what we look for to see, okay, is this something we can start to nibble at? And when you see moves off these really low levels, it tends to be a good thing going forward. Forward returns going out a year are very good, somewhere between like the 20 to 25% a year range on average. The question remains, at this time, will this be, another bear market rally like we've seen multiple times this year, or will this be, the beginning of a new bull market? And it's hard to say. We saw some indications in what ended up being a bear market rally in kind of the July, August period that suggested that, the going out a year should be really good. And so we're hopeful that that's still the case. Yeah, we had another kind of retest of a low. It looks like we could be bouncing off of that now. And I'll be honest, a lot of times with bottoms in the market, they're not like 2020 where they're straight down and straight back up. Most often you're going to kind of retest the bottom and more often than not take out the previous bottom just to really scare people. And then you kind of move up from those levels. So we're hopeful that we see that. The downside of doing that is that when you look at where support is now on the S&P, it's down around 3250 to 3300. That's another 10 to 15% down. Well, obviously would not be good to see that again. But I think all things considered, I'm feeling a little bit more positive about where the market is right now than maybe I was a couple weeks ago.
Yeah. And Chuck, we're continuing to see the relative strength come out of value, which really has been the trend for 2022. Yeah.
So it's been doing pretty well, through this kind of this move down in September and earlier October. Value it still went down, but it still demonstrated some relative strength as it has most of the year, which is it's good to see. And part of that is going to be the energy trend. Energy the entire year has just been unbelievable, really. But of course, part of that's the whole Ukraine war and all the geopolitical tension involved with that. But last time I looked, I think the energy was up somewhere in the 40 to 50% range for the year, which in every other sector is down. So and you would think, okay, well maybe that's just when the market's actually bouncing, it's doing well. But now it's in this past month when the market sold off, let's say about 9%, energy only fell about 1.4%. So it continues to show strong relative strength as it has most of the year. And it's picked up some rankings and in our sector rankings along with things like consumer staples and financials.
Right. And Chuck, let's switch gears and talk about fixed income for a moment, because you mentioned last month it was overbought and now it's even more overbought.
Right. Yeah. And sometimes that happens, right? I mean, these, technical indicators like this, just because something is overbought doesn't mean that it can't get more overbought, but it does suggest that, at least over, the shorter term, we should see some kind of a pullback. That doesn't mean that the rate story is going away anytime soon. It just means that you should see some kind of mean reversion. And where that mean is right now is about at the 3.4% level on the 10-year rate. And, right now it's around 4%, which is up around, basically the peak. That could all change given some kind of new upside catalyst from Chairman Powell or, some other area of the world. It's obviously a very volatile period for rates. But within our fixed income rankings, we're still seeing a lot of relative strength out of areas that are less sensitive to rates. Right? A lot of people kind of forget that there are segments of the market that aren't as sensitive. So things like short duration treasuries, things like municipal bonds, high yield bonds, preferreds, these things are all holding up on a relative strength basis, at least better than some of the alternatives. And an alternative being something like long duration treasuries, which it's really unbelievable. If you go back to the peak of long duration treasuries, we're down 45% from those. That would be an insanely bad equity meltdown. And we're seeing that in long duration treasuries. So it's just really unbelievable.
All right. And Chuck, let's wrap up here in the last minute with commodities still ranked number one, but we see cash slightly strengthening to threaten to take that rank.
Yeah. So as commodities, they've kind of stabilized. They've been number one most of the year. Cash has moved up a lot in the past month. It's getting pretty close to taking the number one rank, but it's not quite there yet. And within commodities, we're seeing agriculture still ranked number one, has been the past couple months. Energy is starting to move back up. It briefly fell to number two. And within those spaces, we've seen things like heating oil and energy is up 18% the last month. Orange juice and agriculture, up 17%. And everybody's talking about natural gas, over in Europe and what that's going to mean for prices going into winter for Europe. But we've actually seen natural gas fall about 30% in the last month, giving them hopefully a much needed reprieve in their energy costs.
All right, Chuck, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.